wanted to talk about different financing options for real estate investor, for example, for single family homes.
1 in 10 homes in America are actually rental properties, rental property homes, and they are not necessarily just, single family homes for buyers. So single family home rental income is a lucrative business, but knowing how you get to this lucrative business is very, very important. So let's start with that. So number one is, of course, through a traditional mortgage loan. Most people are going to go with a traditional loan in order to buy their home, and it's their first home. And a lot of people are going to come at investment can come later, or investment can be something in mind when we're starting our journey as a homeowner, but just to have it in mind. So number one, traditional loan, what do you want to talk to me about that?
Traditional mortgage also is one of the most common method for refinancing. Let's make an example. For example, financing. For example, if you're purchasing a rental property, cost $250,000, you must do at least 20% down, which is $50,000, and then the balance, which is $200,000, you need to finance that $200,000.
Now, and again, if you're doing it as an investment, your interest rates are going to be higher. Why? Because your risk is higher for banks. They understand that if times get tough for you, the first house you're going to save is your own house, not your rental property.
Exactly.
So therefore, they know that about you, so it becomes riskier. So they do have a higher interest rate when it comes to investment properties. Number two is, of course, fixed rate, which we always recommend. I would recommend, unless you have a very specific business purpose, to do another. But this is basically that the interest rate is going to remain the same no matter what, so you can always budget. Now, what's the exception to this?
Exception, what this is, you wanted to talk about ARM mortgage. The ARM mortgage always starts with a lower initial interest rate that they can adjust it over the term, and then over the time, and it could be 3, 5, or 7 ARM, which is for 3 years. You have this lower interest rate, or for 5 years or 7 years. And also could initially, depends on the market, when the interest rate was high, that could be one of the options. Instead of paying like 8%, you're paying a little bit lower, but you can keep 3 years at least that lower interest rate.
I would say the most common one I see with this one isn't 3 years, it's 5 or 7. And why is it 5 or 7? Because your kid's going to go to college, you're buying an investment property near the college so they can live in it. And then your intention is not to keep it 30 years. Your intention is to keep it 5 years so they can go to school, and then you're going to sell it and make money and move on with your life. So this is a very common one I see in this situation. So if you're not going to be in that investment for 30 years and you're only looking at 5-year terms, then sure, you're going to look at that one.
And then before that, we're going to do our introduction.
Actually, let's hit it. Hi, it's Alan Victoria. Welcome to our channel and podcast.
And if this is your first time in our podcast and YouTube channel, make sure you subscribe and get notified.
Also, you call text all the time, 252-327-3357. We love talking to you. Don't be shy. Also, grab our buyer's guide and seller's guide in the description below. Now, let's talk about very, really old school methods of investment. And this is basically how many people have started. Owner-occupied properties that eventually become your single family home for investors later is a very common method. Now, with all of these, you do have to live in the house for at least a year. It could be more. So you really have to understand, if you are taking a government loan, you're going to be living in this house. Now, you don't have to live in the house forever. You can live in the house once, say, hey, I want to move on, keep that house as an investment, and then move on to the next home as well. So this is a very common method that people do. And why would they do that? What's up with the FHA loan?
Because you can get a lower interest rate, no?
Mm-hmm. And your credit does not have to be 100.
And your credit doesn't need to be as high as what they use for the conventional loans.
Right. Now, you are paying the mortgage insurance premium on your FHA loan, but it does not have to be. It can be part of the process, and it can get you started. You are going to live in the house at least a year with this one, as we said, but there are reasons to go this way. Another one is the VA loan, no?
Exactly.
How does that work?
VA loan also is available for the veterans or the active duty service members, and also they are offering finance with no down payment and no ongoing mortgage insurance, which is super important.
Right. So
for the cost.
Right. So if you're looking to get into something, start your life in something that you can get in with really little money. It gets you started and gets you into a home that eventually you intend to make into an investment property and move on. Exactly. So another thing to talk about, maybe those things aren't going to work for you. Maybe you need a portfolio, a bank statement loan. This is where banks look at your books rather than the secondary market. This can be more flexible. They will have different terms and different types of scenarios. So I would really read the terms of what you're signing up for very carefully. It could be you cannot do anything for 5 years. It could be that you can pay it off whenever you want. You definitely need to know the terms, but it's going to be based on your bank statements. And yes, you are going to get a higher interest rate, but you can still get the house based on those interest rates.
And then some of the banks, really local banks, offering 25 years, for example, portfolio loan with a 5-year balloon payment, meaning that you need to
Again, you have to look at your terms. That's why I was saying that. You have to look at your terms carefully. The next one is hard money loan. Tell me about that.
Hard money loans also is asset-based options for the higher interest rate and also shorter terms. Often the property that needs renovation, like people using it for flipping the house. And real estate investor usually or typically use this kind of finance to get on with their life quickly. I mean, you fix the property, you pay higher interest rate, but you can right away selling it.
Right, so basically you do have to own a property for a certain amount of time to accept certain loans, so you have to take that into consideration when you're doing a hard money loan. I would say that this is a way a lot of people do fix and flip. The next one is private money lenders. So this is, again, kind of goes with those hard money loans. This is basically you're going to find a group of people who are investors interested in funding that real estate project for a certain return on that investment. So when we're talking about you want to buy a fix and flip, you want to buy a rental property, like maybe your uncle and your cousins all come in, and then by putting all the money together, you get a better loan, and you're going to have different payments in that situation. Or you're buying the house in order to flip it, and everybody's expecting when you sell it to get a certain percentage of the sale.
Exactly. The next one that many people, they might like it, is a seller financing, which this means that the property owners really is acting as your lender and allowing you as a home buyer or investor to make a payment directly to them under the agreed terms. And this way it can be advantageous that the seller, if the seller is motivated to do that, to sell and buyer cannot secure traditional way, could be like your credit score or debt to income ratio. This is easier at some point for the home buyers.
The next thing to talk about is HELOCs or home equity loans, which is HE loans at this point. Basically, HELOCs are dead. HE loans are more in at the filming of this video. Basically, you take the money from your home that you already live in, and you take that money out, you refinance the home, and then you're secured by a current rate of that home. So you can take up 80% of the value. You have to leave 20% in there, minus whatever you owe. So it's going to give you a potential way to get some money to go reinvest into something else.
The last one we wanted to talk about is crowdfunding and syndication. What are those?
Okay, so there's modern tools online. I can go on Amazon now and buy into these crowdfundings for real estate. So basically you can just put in $100 onto the account, and then basically we're buying a property together, all together. But really we're going to contribute a certain amount of money towards a pool. You're going to get a monthly check based on your investment. Obviously you're not going to get much for the $100, but understanding there are ways out there. REITs are real things. Crowdfunding is a real thing.
Exactly. Therefore, understanding all these financing options allow you to strategically plan for your passive income as a real estate investor, and also control your destiny and your loved one. And this is going to help you to come and consider to plan that it benefits you and your family.
Right, so all of these things are just choices people make, and we are so excited to talk to you about your own real estate journey and how we might be able to help with that. We are real estate agents in the Greenville area, and we love to talk about properties all day long.
And call us and also watch these videos, and we love to connect with you in next time.